Hey everyone, welcome to the channel if you're new. Today I wanted to start a new stock market series where I go over all the macroeconomic news that has happened in the past week, as it's very hard to keep up to date with everything that's going on. So if you found this video helpful, like the video and subscribe, as it does help out a lot. And let's get right into the video. So to start off the week, we found out that SVB Bank and Signature Bank, which were the two banks that failed in the previous week, were bailed out by the government. So anyone who had deposits in these banks had all their money safe. Previously, there was only the FDIC insurance, which is covered by a federal agency, the Federal Deposit Insurance Corporation, where up to $250,000 is reimbursed if the bank fails. But a lot of rich investors will definitely have more money than this. So it's kind of like a bailout for the rich. And this is a little bit of a controversial topic that a lot of people are discussing about. It's also very surprising to see that this was made so quickly, because during March pandemic, it took over a month before the feds really stepped in. And during the great financial crisis as well, it took a long time for the feds to step in. But it looks really quickly now where just in a couple days, the feds are already stepping in and saying that the deposits for the bank is now safe. So that's very telling for the market. As soon as anything even slightly bad goes wrong, the government is going to step in very quickly. Right now in the market, traders are thinking that there's an 85% probability of a 0.25% rate increase when the next hearing comes up in March 21st to 22nd. In the previous week, people thought it was going to be a 0.5% move. So like I said, things are changing very quickly. This week, we also found out the CPI report, and we found out that the rate of inflation has gone down to 6% when we compare it to last month, where it was 6.4%. So this is a lot lower than the peaks where it was at 9.1% in June of last year. And a lot of retail investors don't understand how this number is actually calculated, because what it's calculating is the rate of increase from the previous year. So people think, hey, I'm still paying so much for my groceries, my gas, when you compare it to pre-pandemic. But all these rates are measuring is just a rate of increase from the previous year. So February of 2022. And even the Fed, what their goal is to get the rate of inflation to 2% from the previous year. So you are never going to see the March 2020 levels of prices. That's something that retail investors need to understand, that you are going to be paying these prices no matter what. All the Fed is trying to do with these rate increases is slow the pace of increase of inflation. But even if they do nothing, the comps are going to get so hard, because when you compare to June 2022, gas was $100. And right now, the price of oil has gone down to like 65. So you're paying way less for gas. And when you get to June of 2023, don't be surprised when the rate of inflation is maybe 4%, 3%, very close to what the Fed is trying to get their rate of increase to. Their target, 2%. We also got some news from OpenAI where they have announced their ChatGPT, GPT-4, and they claim that it can beat 90% of humans on the SAT. So currently we were on version 3.5 and they have announced this latest version. We don't know yet when exactly it will be released for the public, but they did do a demo this week about it. And mainly this is going to be a problem for Google. They are trying to release their own product for competing with ChatGPT, but ChatGPT already 3.5 is so strong. I hope everybody has tried it out yet. It is very, very surprising and shocking how good this AI has gotten. And this entire AI race, it's a little bit scary, because humans, they're kind of shooting themselves in the foot. So the better the AI gets, they want to reduce their own amount of jobs. So I don't really know what the end goal is here, but this is some development on ChatGPT and their additional announcement for their latest release. We also got some news from Suiss, which is a European bank having some issues where they are having to borrow $54 billion from the Swiss National Bank. And this caused the entire banking sector to go down even more than it had with the SVB situation. So this entire week had been very, very bad for the banks. But this bank has always had a lot of problems. When you look at the 10-year chart, it used to be a $31 stock, but in the past year, it has crashed huge. So even before all these problems with SVB, in February, it was a $3 stock then. So it was always doing very bad. So I don't really see it as a big news personally. All I see it more as is Wall Street investors trying to pressure the Fed to stop doing rate increases. So right now, they're going to be doing a 0.25 basis point, most likely in the next meeting, which is coming up next week. But that's probably going to be the last rate increase. And afterwards, they're probably going to keep it steady and decrease it over time as the economy supposedly gets a little bit worse. So that's going to be great for tech stocks and growth stocks, which are really hampered down by these rate increases. We also found out that a lot of the bigger banks are getting a lot of new accounts created and more deposits adding. So we found out that Bank of America got 15 billion in new deposits. And also other big lenders like JP Morgan and Citigroup are also seeing a big influx in new accounts. And this is going to be because of all these regional banks. People are worried about them going under. But the big lenders, they are usually a lot safer, and people are more trustworthy of these big banks because they think they're going to be too big to fail. So a lot of people are switching over from the small banks to the big banks, which should make these companies have a bigger moat over time as well. This week, we also had some volatility in another regional bank, First Republic. And this one, Wall Street is trying to help out as 11 banks pledge up to $30 billion in deposits. So basically all the big banks, Bank of America, Wells Fargo, Citigroup, JP Morgan, they're contributing a huge amount, $5 billion. Then we have the other banks contributing $2.5 billion and $1 billion. So after this news, in the after hours on Thursday, First Republic was actually up. But on Friday, the stock has crashed huge. We see that it has gone down more than 20%, even though there's these new deposits that were added in. And this is dragging down the other regional banks as well. This move is epic. It just went down an insane amount in such a short period of time. Like if you look at the year to date, a couple days ago, this stock was at $123, and now it's trading at $23. So it has gone down 32% just in the past day. We got some news this week from Lennar, which is a great indicator of how the housing market is doing. We found out that they had a Q1 non-GAAP earnings per share of $2.12, which is a huge beat by 57 cents. And the revenue was up 4.7% year over year, which was another big beat of $500 million. And the deliveries increased 9% to 13,659 homes. So everything looks amazing here, but it is a little bit deceptive because we can see that the backlog decreased 19,000 homes. And also the value of the backlog has decreased 33%. The new orders decreased 10% to 14,000 homes, and the dollar value has decreased 18% to $6.4 billion. So the upcoming quarters for Lennar still should be very good because they have a backlog of 19,000 homes. And a lot of this backlog came during the pandemic when many people were buying houses at that time. But we can see that people are leaving their contracts. So a lot of new home owners are backing out of their deals. And this is because the mortgage rates have gone up so high to 7%. So even though it does look like Lennar hasn't been that much affected yet, over time, they should be affected by these mortgage rate increases. If we look at the stock, it's still doing very well. It's almost at the all-time highs still. And who knows, if the Fed does start decreasing rates, we could see Lennar do even better. We got some earnings from FedEx this week. And right after the earnings in the post market, it was up 12%. So usually FedEx is a company that people will say is a good indicator of how the US economy in general is doing. But we can see that the reason the stock went up so high is because they just beat their expectations on earnings per share by 67 cents, which was a massive beat. But the revenue actually missed the expectations by $540 million. So even though the shares went up huge, a lot of this is because they are doing some great cost cutting in the company. So it's not very much indicative of how the entire US economy is doing because their revenue has declined as well by 6% year over year and missed the expectations. We also got some earnings from the Honest Company, which is a big retail investor favorite, as a lot of YouTubers pushed the stock. And this stock went down huge, 33%. And it's really easy to see why. The earnings per share was negative 14 cents, which missed the expectations by 10 cents. So their losses were huge. And the revenue, it barely even gained anything. It was up 1.8% year over year. Also, the margins have gone down to 27.5% in this quarter compared to the previous year. So everything is looking very bad for this company. This is a company that a lot of people are buying as a growth stock. And if you look at this revenue growth, there's basically no growth and huge losses. So it's very easy to see why this company is basically going down to $2 now. It's okay if your company is growing a lot because then people will think, okay, over time, this company is going to become profitable after all this growth after a couple of years. But this company has no growth now and is also having expanded losses. So this is something that people have to be careful about when they get into investing. We got some news from Meta this week where Zuckerberg says that Meta Verified is coming to the US as well. So this is basically a copy and paste of what Twitter is doing with their Twitter Blue, where you have to pay $8 per month for a blue checkmark. So there was a ton of backlash when Twitter did this. And the shares after this announcement had sent the Meta shares down 3%. But really, there's no competition to Instagram and Facebook. So I do think that this is something that a lot of social media companies are going to incorporate as well, like TikTok. So this is going to be a great addition to the service where they're going to be getting more revenue. The main reason why Meta had gone down after their earnings was because they had so high costs from their expenses on the metaverse. So this should be a move that is going to recoup some of those expenses that they had. And I do see this as a positive. I know the stock had gone down a little bit. So, and the subscription price is actually higher than Twitter. So the prices for the subscription is starting at $11.99 per month on web. And you actually have to pay more if you buy it on iOS or Android at $15 per month. We saw that Twitter was doing this as well because all the app stores, they're charging about 30%. So they are adding this cost to the user. And this is actually a pretty high subscription price. So let's see how many people are deciding to pay this much for verification. This is a little bit different type of verification that Meta is doing because they are asking for a government ID. And personally for me, I don't really want to be giving Facebook my ID. They already have so much information about you and I don't really feel comfortable with doing that. But I do think a lot of content creators are going to have some value from paying for the subscription. When we look at the overall market, the S&P 500, we can see that even though there's so much volatility and people are coming up on CNBC and all these talk shows talking about how the world is going to collapse, that we have basically been sideways on the S&P 500 since May of last year. So some stocks within the S&P have had huge moves up or down, but the overall market has been pretty much sideways and steady. When we have a look at the 1-year chart for the S&P 500, we can see that we got very close to the lows in December, where the stock market for the S&P had gone down to 379. And this week, we actually got to 381. So these lows are still intact for the market. And that's very good to see, because when we go further than that, the overall lows for the market and the S&P 500 was in October, where the S&P went to around 360. So we find out that the lows from December have been held, and we actually had a pretty strong rally off those lows right now, where it has gone up a little bit to now where it's trading at 390. So that is good news to see that these levels are holding. And if you are a stock market investor, you should not be worried about all this volatility, because it really hasn't been that big of a range. When we look at the actual price range that we've seen on the S&P 500, from the peak to the trough, it has only been a 17.8% move. So since May of last year, we have only been trading between a 17% range. That's something that people need to be aware of. So we were at risk this week of going lower than these lows that we reached in December. And if we had broken that level, we would have gone down to here, where we would have retested around 360 on the S&P 500. Thankfully, we did bounce off those lows. And it does look reassuring for the S&P 500. But we are again having a downward move Friday today, where it is going down to 390. So who knows if we do break this level. If we break it, we'll probably retest this 360 level. But that's what I'm looking for in the S&P 500. It's still a very small move. Like if we go down from 380 to 360, I know people on CNBC are going to be freaking out. They're going to be saying, oh, the market is over, sell everything. But you have to keep in mind, from a high level, we have been basically sideways on the S&P for so many months. So what is my game plan for next week? Next week, in the midweek, we're going to find out how much the Fed is going to raise their rates. Right now, it is basically all analysts are expecting a 0.25% increase. I would be very shocked if it was 0.5%. I think there's actually a decent chance there could be no rate increase as well. So it's going to be interesting to watch what happens afterwards. I do think there's going to be a lot of volatility during that time. So we're going to find earnings from Foot Locker as well as Nike. And these are great industrial companies to see how the overall economy is doing. Nike and Foot Locker both were having some issues with inventory. So let's see if they have fixed that issue as well. That's something I'm going to be looking into, and I'll be reporting in my video next week, as well as anything else that goes on in the market. So if you don't want to miss out on any of these news, be sure to subscribe to my channel. I will be going over all this information next week as well, and hope you have a great weekend.